Good evening, ladies and gentlemen. Welcome to tonight's webinar. Tonight's webinar is the official launch of the latest JBG structured investments. For those of you who don't know me, my name is Justin Beaton. I'm the head of investments at Sequoia Asset Management and the founder and director of JBG Structured Investments. The investments that we're launching tonight is the ASX200 investment. And also an investment that is correlated to the spot gold price. This is the first time we've launched a product that's actually correlated to gold. We've been watching it over the last 12 months, and the recent pullback, we believe, creates an outstanding buying opportunity. Warren Buffett's always said you buy on weakness or when prices are cheap. Certainly a lot cheaper than where we were a few months ago, the ASX for gold. The ASX200 for the last 5 years, every quarter we've come out with an investment that is linked to the ASX200. Of course, it's trading below and behind a lot of other global indices. We believe it is trading at a discount, but I'll cover that through tonight's presentation. So opportunities most because it is dressed in overalls and look like hard work. Thomas Edison once said, I love that quote because generally on the markets the best time to be investing is when everyone else is too fearful to do so. There's been some outstanding buying opportunities over the last few years across the globe. Now, out of all the investments that we've launched over the last few years, I think there's 37, 34 of them are actually above parity and making clients money. So 92% of our investments, people are actually making cash, which is great. So just to go through the presentation tonight, what we'll be doing, I'll be going through a bit about super to start with, then the 2012, looking at the market and how it performed over the last 12 months, then 2013 as an outlook, then I'll go through the specifics for the two investments, then gold and ASX. Likewise, the income enhancer, which is a great alternative for investors that have cash. You can't borrow like the Income and Equity Accelerator series. However, it provides a very high annual income the first and second year of up to 9%. So I'll go through that in a few moments. Tonight we should go for around about an hour, just to let you know. Sequoia Asset Management hold an Australian Financial Services licence. We deal in financial products. Tonight it's general advice. General advice means I haven't considered your individual investment circumstances. The presentation is for general promotional purposes only. There's a few sample strategies and case studies. Obviously, they include a few assumptions. If there is any changes to those assumptions, it's going to have a material impact on the overall outcome. It's a summary only for the investments. You should obtain a copy of the product disclosure statement. By all means, speak to one of the Sequoia Asset Management investment managers that the majority of you are already clients of, and they'll be able to provide you with that product disclosure statement. Likewise, answer any questions that you may have. So new investments, we've got the JBG Income and Equity Accelerator Series 27 and 28. We're up to Series 28 in that specific investment. The Income and Equity Accelerator, you borrow the full amount. That's right, we'll lend you 100% of the investment amount. The investment amount is capital protected. What you do have to do is prepay 3 years of interest up front for both. For the gold trust, it is in US dollars, so there is also a currency hedging fee. The interest rate is 4.95% to borrow. The currency hedging fee for gold is 1% per annum. The other one is the income enhancer. So this is the investment where you have to fund 100% of the capital. The income is up to 9% per annum. You also, for the first and second year, you also gain capital growth potential, which is capped at 4% per month. There's conditional protection, which means if the underlying investment, the reference asset, whether it's ASX200 or gold, if it doesn't fall by more than 30% over the 3-year period, at maturity, you gain all of your principal investment back, plus any of the growth up to 4% per month, and the income over up to 9% in the first and second year. If it does fall by more than 30% at maturity, then your principal is at risk, but we think that is a low probable event. So to gain the income, the regular income coming through from the investment, we're giving away a bit of the upside by capping it at 4% a month, that is. So it's still strong upside potential growth that we do offer. We also take on a little bit of risk if the market, or the ASX200 being the market, or the gold price falls by that 30%. I'll go through those in detail in a few moments. What I do want to launch on is the SMSF Club. This is a mentoring club that we've been created after being inundated by investors wanting to take control of their superannuation. They want to take control of their superannuation and also act as an informed, educated investor. So we've created the SMSF Club, not just us as individuals, but we've teamed up with a fair few other companies that are experts in their individual field. So we provide monthly mentoring program where we get experts from property to shares, compliance, estate planning, insurances. The basic aim of the SMSF Club is to ensure that you're an educated, informed and confident investor. And the reason why you set up a self-managed super fund as a starting point was to take control of your assets. We give you the capacity to do that. The SMSF Club is going to be run across Australia every month. It actually kicks off next week in Perth. So we do the monthly live SMSF mentoring workshops every month. You gain daily access to a dedicated self-managed super fund head coach for any of your SMSF questions. Our goal is to ensure you are compliant and act as an informed investor. As I said, the entire professional team, from property coaches to stock market specialists, insurance, estate planning, legal and compliance, all these people that you have direct access to hopefully reach or hopefully extend your retirement goals. You also gain access to tailored investments specifically designed for self-managed super funds, and some of them are the ones that we're talking about tonight. These investments are, while you can invest in your own name, specifically designed for self-managed super funds. You go back 5 years ago, there was about 5% of investors that came to JBG were for self-managed super funds. Now it's actually 95%. Also, we'll look after all the accounting and the administration for your self-managed super funds. So we're going to be providing a fair amount of services. It's almost a one-stop shop to be able to help you out with all your self-managed super fund needs. We have two alternatives, and with the introduction of the mini SMSF, it means more and more Australians now can take control of their retirement savings. For a classic self-managed super fund, if you've got a combined super balance greater than 100 grand, the fee scale can be cheaper than what you're paying in a retail or industry super fund. Well, I mean combined super, you can have up to 4 members in the self-managed super fund. So if you've got yourself, your wife and a brother or husband, you combine them all together. If you've got 25 grand each and combine it with 4 people, that's $100,000. So you gain economies of scale when you're combining it with other individuals. We'll look after the complete compliance reporting, ATO lodgement. You basically gain one access online every day that's updated as the investments move. The fees, we'll do it for nothing. If you don't have a self-managed super fund already, we'll set it up for free as the SMSF Club. Ongoing, it will be $3,450 per annum under the classic model, but given that we're just starting the business off now as a founding member, it's $2,950. Now, the average accountant and administration firm charges $3,800 per annum just for accounting and administration, let alone all the education that you're going to go with it. We give you that, and it's almost $1,000 cheaper than what the average accountant is charging. Now, the mini SMSF, now this is designed for younger Australians that haven't accumulated as much money in super yet. So we've got a combined super balance between 50 and 100 grand. Again, it is a self-managed super fund, so you can combine it with up to 3 other members, so 4 members in total. Again, we'll do complete compliance reporting, audit, all those sort of things. You gain access online. The fees is 1.75%, close enough to it, plus $20 per month. Again, we'll set up a self-managed super fund under the mini structure for free. If you compare that fee, it's very similar to the average retail and industry super fund that you're being charged with already. So if you go through there, that's some of the fees that I was talking about. The top 10 self-managed super fund providers. They generally charge around $1,200 to set one up. We'll do it for nothing. The average accounting fee, $3,867, and you can get it now at $2,950, so a lot cheaper than the average just accountant administration. Again, to reiterate, with the other accounting firms, you don't gain the ongoing education. We provide that to you within that one annual payment. So this is average super fund fee, 1.88%. when you look at retail and industry super funds, 1.75 plus $20 per member. It's close enough to the same when you look at the mini structure. So given the fees is usually the main reason why people don't set up a self-managed super fund, because of that high $4,000 accounting and administration fee. We're able to overcome that by just charging a percentage. So the number one reason why most people don't set up a self-managed super fund has been avoided. So we're pretty excited about that, and the mini SMSF has been the fastest growing superannuation product that we've seen in the marketplace. So it's very popular, which is great. So 2012, let's look at the equity markets, which is why we've registered today. 2012 was obviously a year that was dominated by fear, certainly in the first 6 months of the calendar year. Fears were brought about through the media concentrating on a few global events. Obviously, we've had the European crisis that's dominated the media for the last 5 years. Again, in 2012, that was no different, with a lot of the spotlight on Greece and Italy. At the same time, people were concerned that the US growth isn't sustainable over the long term. That was in 2012. But despite that, the US share market, as measured by the Dow Jones Index, is now at all-time highs. It's actually back to higher levels than where it was in 2007. Many people speculated there's going to be a hard landing in China. That hasn't eventuated just yet. I don't think it's going to eventuate. I think they've slowed down GDP growth to more sustainable long-term levels. At 8% GDP growth, which here in Australia is phenomenal. If we got 8%, I think inflation would be a bit of a concern. But because of the urbanisation of the masses of the population in China going from regional areas to the cities, I don't expect it to slow down too much too soon. I expect it to continue the growth in China for decades to come. So many people were fearful of the China or Chinese hard landing, and that hasn't eventuated. And of course, going into the end of the year, many people were concerned about the fiscal cliff. Again, most of that was either avoided or postponed. So we simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. Like Warren Buffett, he's put a lot of money to work over the last 5 years, and so have we. Just because the market is fearful and there's always something to be worried about doesn't mean it's not a good time to be investing. You pay a very high price for certainty, and when most people are concentrating on these uncertainties, you're going to be paying a very cheap price. And the Australian share market, I believe, is still cheap, even after the recent rally that we've experienced over the last 6 months. Despite all of those concerns, the market has actually rallied, as we can see from this chart. We started the year at 4,200 points, or maybe a bit lower. We ended it at 4,500. You look at the market now, we're at 5,150, so the start of 2013 has certainly been robust. If you look at what has dominated the market through 2012 and put it on the chart, just to follow up from the previous slide, we had uncertain Greece debt issues in January. Spain's unemployment hit 25% earlier on in 2012. 10-year Treasury bonds plunged to the weakest level since World War II. In May, further speculation Greece would be thrown out of the euro, fears of a China hard landing. And then in June, the RBA dropped the interest rates here in Australia to 3.5%. In June, there was a Greece election. China inflation figures came out, which meant that the Chinese government can actually stimulate the economy. Most people were concerned about high levels of inflation, and that didn't eventuate. So the fears of a hard landing were overcome in mid-2012. QE3, quantitative easing 3, was announced in the United States. RBA again dropped interest rates by 25 basis points in October. There was a bit of uncertainty around the US election. It was interesting in 2012, while the spotlight was on 3 major countries, which was Greece, China, and the United States. They all had elections last year. And generally, when there's an election, well, China didn't quite have an election, but there was a change of leadership in China that happened late 2012. Because of that political uncertainty, I think markets were pretty volatile. But in those 3 areas, there has been a re-election or a change of power, and that creates a fair amount of stability, hopefully, for 2013. In October, there was fears the iron ore price was going to fall to $50. Obviously, that didn't eventuate. At the time, many people thought Fortescue Metals was going to go broke. So when the market has a pullback, at the moment, that's certainly treated as a buying opportunity because it doesn't last too long, which gives me the impression that we are definitely out of the bear market and into early stages of a bull market. Hurricane Sandy hit in October in the United States, then Obama was re-elected early November. China had their 10-year leadership change around the same time. In December, the RBA lowered interest rates again to 3%, which is the lowest levels they've been at since they started measuring interest rates, back to those low levels post-GFC in 2009. Then the iron ore price obviously didn't get anywhere near $50. It actually hit at the end of the year 120, now currently trading at $144. So there's plenty of reasons to be fearful of the market. There's plenty of reasons to sit on the sideline and have your money invested in cash. Unfortunately, though, when you take out fees in the average bank account, the real return is basically less than zero. The return on your money sitting in cash at the moment is 2.25% in the bank account, and inflation's close enough to that. So having it on the sidelines, having it in cash, means you're not going to be able to achieve whatever your investment goals are. So we need to be taking on a little bit of risk or calculated risk to achieve a higher potential return, to achieve whatever investment goals you have. So while most people are concentrating on the Europe crisis, US growth, the Chinese hard landing or the fiscal cliff, if you were just sitting on the sidelines waiting for certainty, you missed out on the first bounce of the market. If you look at the stock market performance, the year-to-date returns to early December 2012, global share markets rebounded 9%, the FTSE 10, Dow Jones 7.8, Hang Seng 21, and here in Australia 15%. That was for until December 2012. If you look at the performance for the last 9 months, the share market has gone up over 20% since mid last year, 20%, so it's been phenomenal. So there's always something to be worried about. And as I said, when everyone else is fearful, like Warren Buffett, that's the time to be buying. So in the business world, the rearview mirror is always clearer than the windshield. Let's look forward now rather than looking behind us. We know with a fair amount of certainty what happened over the last 12 months and why markets moved the way they did. Let's have a look and see if we can predict what's going to happen in 2013. Given we're halfway through March, we've already seen a lot of things happen in 2013 already. So the RBA are clearly targeting a lower interest rate environment. The key beneficiary of a lower interest rate is a lower Australian dollar. When the Australian dollar is lower, I think that the Australian dollar over the next 3 years is going to gradually fall back to more traditional levels, being around the 80-85 cent mark. If that does happen, then our export market is going to pick up. The mining sector should have increased revenue and demand for their products overseas if the AUD does fall against the US dollar. So that's already the lower interest rate is already started to facilitate a self-sustaining economic and share market recovery here domestically. As I said, China appears to be well placed to rebound following various years of stability. They actually had the first quarter increase in growth in over 2 years, the last time they measured it, which was till the December quarter. So they're showing signs of a recovery, and as I said, that so-called hard landing, it looks like it's going to be avoided. The United States have, as anticipated, implemented further measures to stimulate the economy with QE3. Unfortunately, they can't implement too much monetary policy because interest rates are so low, and their intention is to maintain the interest rate at a very low level for the foreseeable future. The byproduct of low interest rates is generally a solid gold price, certainly in the United States. And while they're printing money and expected to continue to do so, I believe that there's a flaw that's been created in the gold price around the $1,500 mark. That's an ounce. And a few research analysts and economists agree with me from Merrill Lynch. Europe looks to have finally come up with a solution to their long-term economic stability. While I say they look like they've come up with a solution, this thing isn't going to be turned around anytime soon. I'm hoping politicians are going to implement sustainable long-term economic policy that may be able to bring everything that's correlated to the Mediterranean, having a siesta, having a solution in 10 to 15 years. I don't think a Band-Aid is going to be the real solution for the issues that are a lot deeper than that in Europe. Now here in Australia, obviously, while the United States, China, and Greece had all change of powers last year. It's an election year here in Australia, and we've already seen the political circus erupt in Canberra, and that's going to continue until September elections. So look out. 2013, key driving forces, cheap money. We've got access to very low interest rates, so people are going to look at borrowing and going investing those funds, whether it's in property or shares. I believe you look at the companies that have just come out with profit figures, the majority of them have come out with above consensus profit results, and as a result, a lot of stockbrokers and research analysts have increased their share price targets. We've had positive economic results from our major trading partners, mainly India, China, and the United States. So 2013, I'm expecting modest acceleration in global GDP growth led by United States and China and India. In China, the hard landing has or will be avoided. I expect the Chinese GDP growth to recover at about 8% in 2013. So GDP growth to be about 8% and for it to maintain around that level to 2020. I expect the strong US recovery to continue. I don't think it's going to slow down anytime soon, which many people are fearful of, while interest rates are almost at zero, and QE3 basically it's an open-ended checkbook for the Fed to inject money and stimulate the economy. I don't expect there to be much of a pullback at all. Investors, I believe, are going to move money from cash and term deposits to growth assets. Currently, throughout history, pretty much, at least in the last few years, as Australians, we've had the highest savings level that we've had in almost half a century. The amount of money that's sitting in cash or term deposits is at almost record levels. Unfortunately, though, what we've seen is the deposit rate here in Australia fall from around 6.5% if you've got money into a term deposit to around 4% for a bank account, around 4.5% to 2.5%. So many people that are retired or approaching retirement have had their money in term deposit or cash to enjoy a high income stream and to live off that income stream. Unfortunately, if you're living off of the income stream from a term deposit, you've now seen that income go down by 30–40%. So many people in retirement have now had to severely cut their standard of living in retirement. They simply can't afford to live the way they have over the last few years. So what we're seeing is people moving from these term deposits and cash into high dividend paying shares. And they realise by moving their money from being in a Westpac term deposit to Westbank shares, they are taking on equity risk, but they're forced to simply to maintain their standard of living because of the high dividend income they enjoy for equities. Now, it's not just for the retired people. There's many professional fund managers that have been sitting on the sidelines that are now injecting money into the market. And that's what we've seen over the last few months. Any pullback has only lasted for a day or two. We've seen the market rally for a few days following that to create short-term highs at least. That's on the basis that there's so much money on the sidelines. Any short-term pullback has been treated as a great buying opportunity. Now, this is the last time, if you look at the blue line on that chart, the last time the official cash rate got back to 3%. If we look here, it's the last time it went back to 3%. If we go down to the coinciding where the share market was at that time, the ASX was trading at approximately 3,200 points. If we go forward 2 years after interest rates got to such low levels, now this is trying to show you why people move from cash into equities and what happens to the share market as a result. We've seen the market, as people were transferring from term deposits into shares, the market last time, we're down at 3%, go from 3,200 points to 4,800 points. That was a 50% rally that happened in 2009 over a 12-month period thereabouts on the back of these people shifting from cash into growth assets. Now the RBA official cash rate is back at 3%. We've already seen the market since December rally quite substantially as people were moving from these safe havens to take on equity risk. So hopefully, even if it does 50% of that, so 25% over the next 2 years, it's still a very good performance for the ASX. Also expect the gap between profit and price to continue to close, and this is a chart that I've been using for the last few years, or 4 or 5 years, just to show you the relationship between price and profit. Now, over the long term, the only true dictator of profit, of price is going to be profit. Like, for instance, if a company is not going to make money, it's eventually going to go broke. So if the market was efficient, the share prices should directly reflect the profit and future profit that a company is or could make. But unfortunately, in the short term, the market is a voting machine and it's dictated by the emotions of investors. So if you look at this chart, this is released by the ABS. It's a business gross operating profit that's released every quarter. So if we go back to 2002, as we can see from 2002 to 2008, profits were increasing. As a result of the GFC, we saw in 2008, 2009, profits declined substantially as a flow-on effect from the global financial crisis started to impact businesses. Where we are today, we're pretty much at all-time highs. We're a lot higher than where we were back pre-GFC. Now, if the market was efficient, and I put a chart of the Australian share market up, it should be exactly the same as operating profit. But if that was the case, I'd be out of a job. It'd be pretty easy to make money on the share market. However, because it's a voting machine, we're presented with outstanding buying opportunities as the market goes below that orange line. So this is the share market over the same period. So you can see from 2002 to 2007, the market rallied a lot. We then had a fair correction. The market fell over 50% in the GFC in 2008 and 2009. And then we've traded sideways for the last few years between 4,000 and 5,000 points. 5,000 points was a resistance level. Now we've spent some time above that, now trading at 5,120 points. I think it's gone from a resistance to a great support level. I believe between 5,000 and 6,000 points will be the quickest 1,000-point movement in history. So pretty bullish on the equity markets. And this is why. I like overlaying two charts, and that gives me an opportunity to determine if the market is overvalued or undervalued. When the green line is below the orange line, we can see that the market is undervalued, that the price is a lot lower than profit. If you look through 2002 to 2003, the green line was below the orange line. That was a good time to be buying. So the green line generally trades very similar in the same direction as profits. Then when profits declined, the share market fell. The reason why it fell much further than price profit was simply because of the amount of leverage that existed in the market. Because of the high amount of leverage that was in the market, it was like a pendulum. The market goes from overvalued to extremely undervalued. So where we are today, the market has had a bit of a rally. The ABS releases its figures about 3 months after the profit figures are actually recorded. So where we are today, the market is extremely undervalued in comparison to price. Eventually, I believe these two lines are going to come together. Now, I'm hoping the green line is going to go to the orange line. In fact, the orange line will go higher. However, if the orange line goes to the green line, then profits have declined. But given the entire global environment where it is today, I can't see profits falling back to below where we were at the bottom of the GFC. So I'm pretty bullish on the market, and I've drawn some pretty colours there. Not too sure if you make sense of that. But if you can take away that the further the green line is below the orange line, the cheaper the market is. And where we are today is well below that orange line, even after the recent rallies that we've experienced over the last 6 months. Now, I also expect that the gap between the Dow Jones and the FTSE and the ASX to close. That is, the ASX to catch up to the Dow and the FTSE. So as I said before, the Dow Jones has gone on to new highs. It is at record levels, pre-GFC levels on the Dow Jones Dow Jones Index, which is surprising given that all the problems that existed that caused the GFC came from the United States. But despite that, they are at record high levels. The FTSE is not far from it. The FTSE is catching up and almost at all-time highs. Yet here, if we listen to Wayne Swan, we are the envy of the world. Well, if we are the envy of the world, most people aren't looking at our share market. In fact, Wayne Swan last year got the Treasurer of the Year. They didn't look at the performance of the share market, because had they done so, they would realise that our share market isn't performing too well. And it's got a long way to catch up to the other global indexes. So there's our share market when you overlay it on the FTSE and the Dow. As we can see, they fell pretty much at the same levels. Our market started to recover with the FTSE and the Dow, but since then we've traded sideways. For us to catch up to the Dow, we need to go up approximately 35%. We need to go up 35% to catch up to the Dow. So we've got some good upside. Now, sure, here in Australia we've had a few things that other economies haven't. Like we've had the mining super tax, we've had the carbon tax that's been introduced over that time, and maybe that is a reason why our market has underperformed the rest of the globe. But I expect ours to catch up. At least if the currency falls back to 80 cents, then the green line should catch up to the blue and red line, irrespective of what happens to profits. So uncertainties and risks remain, look, not least the fiscal cliff, but if these can be navigated, which we believe is the most probable outcome in the next few months, we'd expect a more convincing upturn in global indicators and equities. That's from UBS Investment Research 2013, and I agree with it. So while markets had a rebound, we're still pretty bullish here at JBG SI and also Sequoia Asset Management. We believe the most undervalued equities index in the globe is the ASX. If there was anything else that we thought was a better buying opportunity, I'd be talking about it. This is an economic clock. Many people refer to the economic clock, at least if you go to university studies or any form of finance and investment studies, most people talk about the economic clock. What we can see here is that what we've got are corporate failures, slowdown, gloom, tighter money, which has certainly dominated the market over the last few years. We had falling real estate values. Today, though, we're seeing in the last 6 months falling interest rates. There has an uneven recovery and rising share prices. So you look at the economic clock, I believe we're somewhere between 7 and 8 p.m. If that is the case, and if this clock ticks in a clockwise direction, we've got some pretty good times to enjoy in the future. General recovery, then a strong recovery, and then boom time. So let's hope the next 3 years we get to enjoy some boom times. Look, as an investor, many people have actually questioned why I'm always a long investor. But when I mean a long investor, I always buy on the or make money. My investments are structured to make money if the market rallies. Sure, they've all generally got capital protection to minimise the risk on the downside, just in case we're wrong in the short term. But all our investments are correlated to markets going up. The reason why is because of this long-term trend. This is the Australian share market. The ASX releases this chart every year. It's updated. If you look, it starts at the bottom and finishes at the top or close enough to it. Throughout history, markets have always gone on to create new highs, and I expect this time to be no different. What we're 5 years into the bear market, since those highs were created back in 2007, maybe a little bit more. Eventually we'll go on to create new highs. Why I'm confident with that, I'm not too sure of the time frame of it happening though, is that we have increased profits, we've got a growing population, wages are increasing, unemployment is at very low levels, and interest rates are at very low levels. While that is the case and we're productive as a human race, chart will always go from the bottom left to the top right. Sure, throughout history there's always been a reason to be worried about in the market and a correction that has occurred. If you look out throughout history on that chart, like in the 70s, the oil crisis, 87, September 11, the 30s, the Depression, they were all great times to be looking at investing, not sitting on the sidelines waiting for things to feel good. You wait until things feel good, you're going to be paying a very high price. This is another chart, like we often hear at Sequoia. We've got a very diverse amount of people from all different asset classes. So we're always having a debate as to which one is the better asset class, whether it's shares, property, fixed interest, cash. And over the last 10 years, despite the GFC, despite the pullback, the actual Australian share market has still been the best performer, being the red line on those charts. Then you've got property, houses, units, and then the slow performer is the Australian Property Trust. So the Australian shares have still been a great way to be making money over the last 10 years, despite the recent pullback. As I said before, we're up to 47 investments, or 37. The ASX, we've had a few of them. If you look at the performance of the ASX investments, What we're up 21% for Series 1 roll down since June. Series 2 roll down, which is since September, it's up 15%. 10, 10, 7, 7, 5, 7, 17, 28, 23, 28, 17, 23, 26%. So all of our investments that are linked to the ASX200 are making money. And some of the returns is actually quite spectacular when you look at the return on the investment. That is the return, rate of return that's quoted there as the performance figures. So with the performance of investments, we do have a track record of providing solid returns to our clients, which gives you comfort that hopefully that's going to continue moving forward. So if we look at our Income and Equity Accelerator, the ASX series, that's the past simulated performance. If you look at the performance, the average 3-year rate of return is 19% on the ASX200. For our investment, it will be about 23. Now, past performance doesn't repeat itself, but as you can see, we generally track or slightly outperform the underlying market. We outperform, or we can perform different to the ASX200 simply because we have what's called volatility management incorporated into our investments. So we give you the potential for high investment returns because we're linked to the share market. That is determined by the ASX200 being the index, which measures the largest 200 listed companies in Australia. The investment term is approximately 3 years. Why it's 3 years? Every quarter you've got the capacity to redeem. Capital protection applies at maturity. What that means is that if you invest 100 grand and borrow 100 and we're completely wrong, the market falls by 50%, you can walk away from the investment and the loan amount. The maximum you can lose is the interest expense plus the application fee, which I'll go through in a moment. It's compliant for self-managed super funds, and given the loan is a limited recourse loan, you can borrow the full amount to invest. Out of the super fund, 15 grand thereabouts will give you $100,000 notional exposure to the underlying index. We'll be paying out contingent coupons of up to 10.8% per annum in the first 2 years. That's contingent on performance. If the underlying investment doesn't go up, then that coupon may be zero. While we pay up to 10.8%, it's sort of like harvesting the growth along the way, locking in those gains. There's a compulsory limited recourse loan. That's for the full 100% of the investment amount. You prepay the interest up front. The interest rate is 4.95%. We gain access to wholesale rates and we pass them on to you as an investor. Where we get paid, where we make a profit, is through a performance fee. We get paid 10% of any performance that you make. So for that, well, I suppose we've been recognised in the industry for instigating a bit of ethics and integrity back in the market. My belief is that you pay someone when they add value. When they add value, you pay them a lot. If they don't add any value, they don't deserve too much. If we make you nothing, we get paid nothing. There is a one-off application fee of 2.2%, which goes towards covering our cost of putting the investment together, to keep the lights on, to ensure that we're in operation. So it's just to cover the cost of running the business. Where we make a profit is in the performance fee, which is when you make a profit. The key risks, obviously there's no guarantee that ASX or actually the investment will generate a return, let alone a return that will cover the cost of the interest expense, the currency hedging fee, if you've got the gold series, I'll talk about that in a moment, and the application fee. The capital protection only applies at maturity, so if you redeem early you don't get the benefit of that. You can lose all of the prepaid interest and your application fee. There may be no coupons. If the investment doesn't go up, then we can't pull a rabbit out of our hat. We need the underlying investment to go up before we're going to make money. As I said before, I'm pretty confident that the market is undervalued and hopefully set for a fair recovery. With volatility, we adjust the participation rate, our exposure to the ASX 200 in accordance to volatility. If volatility is high, we can have as little as zero exposure to the underlying. We can have up to 150%, which is what our exposure is for the majority of our investments now. What that means is if the market goes up 10, we can actually make 15% when volatility is very low. Conversely low, though, if volatility is low and the market falls a lot, we can lose a lot more than the market. And that's often why we either underperform or outperform the underlying index. There's no guarantee the reference asset will increase in value, and then there's the counterparty and credit risk. While it's limited recourse, if the counterparty goes broke, you can just walk away from the loan, the investment amount. The protection is provided in the loan by or it's backed by a global investment bank that's got an above investment grade credit rating. So we're pretty confident that the credit rating won't be an issue. When you borrow money, obviously gains and losses can be magnified. If the total outlay is 15%, and that's the maximum amount you can lose. If you borrow 100, your maximum you can lose is 15 grand. If you borrow $1 million, the maximum you can lose is 150. So the more you borrow, the more you can lose in dollar terms. So we look at the example. This is Peter and Ann. Peter and Ann, they're interested in gaining exposure to the Australian share market and also the gold spot price. They're a believer that the gold price is undervalued. They're a believer that George Soros, Jim Rogers, all those type of guys that are long a lot of gold, they're happy to buy it as a defensive asset. Likewise, the Australian share market. They want to borrow the amount to invest, but they're only willing to borrow if there's capital protection, so they don't have any risk of margin calls, God forbid. As they believe the ASX200 index in gold is undervalued, they also want to invest in their own name plus their self-managed super fund. So because their limited recourse loans with the capacity to borrow the full amount in your self-managed super fund. So 15 grand outlay will give you close enough to $100,000 exposure to the ASX200. So if we look at the ASX200, let's look at the total investment amount of being 100 grand. You can borrow the 100 amount. In fact, it's a compulsory limited recourse loan. Year one, you've got to prepay the interest for 3 years. So you prepay 4.95% times 3. This is going to cost you up front $14,850 in interest. You've got the 2.2% application fee. That's what covers our cost. That's $2,200. So your total outlay for the first year is $17,050. Yet you've got 100 grand invested. You've got nothing else to pay for the second or third year because you've prepaid all of those expenses. The interest rate is fixed for the entire term. So that's the maximum amount you can lose. So let's look at an example. Let's say the market falls by 60%. Your initial investment is 100 grand. You borrowed 100. It's now worth 40 because of the 60% fall. Capital protection kicks in. You got a benefit of 60K. So you get 100 grand to pay back the loan. The total risk and cost over the entire investment term is $17,050. Now a lot of that should be tax deductible. So I'm not an accountant. It's important to seek independent tax advice. If it's not deductible, it's treated as a capital expense on the investment. So that's the interest plus the application fee. That's a maximum amount you can lose. So we need the market to go up close enough to 5.5% per annum to break even. Let's say the investment goes up this time by 30%. So less than 10% a year, 8% compounding. So certainly not the 20% that we've enjoyed in the last 6 months, but just 8% compounding is close enough to 30% over the 3-year period. Your 100 grand is now worth 130. You've still got the 100 grand loan. So the total final coupon at maturity is $30,000. You'll pay us 3 grand as a performance fee. Total return is 27. So you've actually turned what was 17,000 out of your back pocket into 27 grand. So the return on the investment in this example, why it's gone up 30% per annum, as a rate of return, your return on your investment is almost 50%, might be a little bit more. So you can gain a solid return on investment because we've got capital protection and also gearing. This is the ASX200, as I said, so it goes up, goes down. We've outperformed. The average 3-year strategy value of the performance is 23.62%. That takes a lot of the downside in the market, as we saw before. So let's look at gold. Now, gold's an interesting commodity. I've been watching gold for the last 12 months. I've had various conversations with who's referred to as the gold king or the commodities king, Jim Rogers, about the outlook of the commodity. I'll show you an interview in a moment from Jim Rogers. Because his view is that over the last 6 months, certainly back in May 2012, the gold price was due for a pullback. Now we've had that pullback. We're ready to look at investing in the market. Gold is generally considered a protection against inflation. Many people have seen where the interest rates around the globe at almost zero, certainly in the United States, Japan. There's two global leaders with inflation concerns in those markets, them printing a lot of money. There's a lot of investment going on in gold as a defense asset. So many economists expect the flow-on effect of the US printing money will be high inflation with high inflation, gold has historically performed very well. Gold's recent price slide has been going on for a few months. February marked the 5th month in which it fell, which is the longest run of monthly decline since 1997, which has created us an outstanding buying opportunity, I believe. With emerging markets getting richer, we anticipate gold demand to increase, not just from investment purposes, but non-investment purposes. In India, they're the biggest consumers of gold. In fact, in India, they eat gold, apparently. So we expect that demand to increase as the people in poverty in China and India move to have more and more income and disposable income. They'll be taking on more luxury goods like gold. But that being said, we also expect the demand for gold from investment purposes to increase as well, as people are trying to protect themselves against inflation. The risk to the gold price, I suppose any abrupt spike in real interest rates that put an end to the upcoming monetary easing cycle, certainly in the United States, may drive investors out of gold and create downward pressure on the gold price. That would be one of the main reasons that we've had the pullback over the last 6 months. So with gold, Capital Economics, which is a UK economic consultancy firm, they expect gold to reach a new record of 2,000 by the end of this year. We're currently just above 1,500 an ounce. So that's a 30% rise in 12 months. That'll be pretty good. They said Capital Economics, the UK economics consultancy, says gold will reach a new record of 2,000 later this year, warning that the Eurozone will flare up again and the rallying equity markets may run out of steam. That is not quite as eye-popping a forecast as it might seem. As we go back and consider inflation, the price of gold was considerably higher back in 1980. So when you take into consideration inflation, it was about 2,400 an ounce. That was an article that came out in the Sydney Morning Herald just yesterday. So the outlook for gold, according to Capital Economics, is pretty good. This is George Soros. George Soros is a very famous investor. He's in the Forbes rich list all the time, and he is long a lot of gold. Personally, he's worth about $19.2 billion, and I believe personally he has $97 million worth of gold bullion sitting in his safe. Not bad. He's a very successful investor. He's made billions of dollars by short selling the pound sterling back in the 1980s and 1990s. He's a good investor. His few investment successes or a few quotes that I've got: investing is entertaining. If you're having fun, you're probably not making any money. Good investing is boring, and I agree with that. Good investing requires a lot of patience, sitting on your hands. If you're active in investment markets, you're generally losing money. If you're after an adrenaline rush or short-term trading, you're in the wrong webinar. Our investment strategies are put into place to make money over the long term. By the long term, it's 5 to 10 years. While there's 3 years, that's when the capital protection expires. Would hope you would extend by implementing active management. If it's up, you make money, so you can lock in gains. If it's down, you can roll down. So even if it's down, we can make units. If it's up, we make dollars. We're very boring investors. If you want an adrenaline rush, go jump it over a plane. It's cheaper and probably less risky than stuffing around or trying to dance in and out of equity markets. Markets are constantly in the state of uncertainty and flux. Money is made by discounting the obvious and betting on the unexpected. Now, many people are expecting the gold price to continue its downward spiral. Many economists, but these so-called experts like George Soros and Jim Rogers, are saying now's the time to be entering in the market. And for me, I somewhat agree with them. Markets are designed to allow individuals to look after their private needs and to pursue profit. It's really a great invention, and I wouldn't underestimate the value of that. But they're not designed to take care of social needs. When it comes to maintaining your standard of living in retirement, you need to be looking at gaining a higher rate of return than having your money in your bank account. Equity markets have been a great place to look at investing. So this is John Paulson. He's another billionaire. He predicted the subprime mortgage market made a lot of money when it collapsed in 2009. 2008, 2009. Net worth $11.2 billion. Why I'm using these people is that we read a lot of articles in the newspapers that are facilitated by journalists, and those journalists just generally don't have too much money to their name. Rather than trying to decipher between that, let's look at the experts and look at where they're parking their money. John Paulson, he actually has 3.54 billion of the ETF that's linked to the gold spot price, which is what one of the considerations we've got to hedge our position when you use the spot price or the ETF, where he has a lot of money parked. 800 million of gold derivatives and equities contracts. So you look it all up, he's got over $4 billion exposure to gold. He's very bullish on gold. Paulson's gold thesis is straightforward. In a world of quantitative easing like QE1, QE2, QE3, he believes the yellow metal gold will benefit as central banks print money as distributed throughout the economy. The new money could take multiple years to circulate. Paulson argues that once it does, the inflation will go up, and that will buoy the price of gold. Despite the volatility and the drawdown of our gold equity position, we believe in the long-term outlook for these positions as quantitative easing programs continue around the world. Credit expands in the United States, and gold equities continue to trade at a significant discount. John Paulson, again, very bullish on gold. Jim Rogers. Now, Jim Rogers, I've spoken to him numerous times on the phone. He's an American investor and author. He's traveled around the globe. He's looked at various things. He's achieved a few Guinness Books of Records. He's on Bloomberg, CNBC as a regular commentator. He believes commodities is the place to be investing. He believes that farmers will be the ones driving Lamborghinis, and investment bankers will be driving taxis to supplement their income in the future. Jim is obviously very bullish on gold and has a big exposure to the gold price. He's come out just recently that, actually this was in May last year. If gold goes down more, I hope to buy more. If it goes down a lot, I hope to buy a lot more. The time to step in is when everyone is pessimistic. That's where he's referring to today. And gold will end in a bubble. He does expect that, but he doesn't expect the bubble to be created until 2019 and 2021. In the meantime, if you do not own gold, I urge you to go and buy some. I'll show you a quick interview with Jim, hopefully, where we can see some of the outlook that Jim has. Let's play this. It only goes for a minute. It's his comments about gold. Hopefully you can hear some.
I own gold. Gold has been up 11 years in a row now. Very unusual for any asset class to go up value. It's correcting now. I would expect to continue to correct for a while. I know that I'm in one single market in the world.
You might be having a few dramas with the sound tuning phone. Bear with me one tick.
Surfing, and it lost its assets the world reserve currency. I own gold. Gold has been up 11 years in a row now. Very unusual in investors now who expect us for a while. I have no idea. I'm not even having a single worst mark.
Somehow I don't believe that.
I'm getting feedback. We can't hear much. So apologise for that. If you like, I'll send you the link to the interview with Jim. He's saying that if gold does go down, he expects to buy more. He expects it to go up higher. There's nowhere near possible yet. Maybe 2019, 2020. Probably gold will get up, and I'm hoping I'm smart enough to sell. In the meantime, if you don't own any gold, I urge you to go and buy some. Hopefully you got that then. If not, as I said, I'll send you a copy. Let's get rid of Jim there. Ooh, what happened? So that's Jim. Gold will end in a bubble maybe in 2019, 2021. In the meantime, if you don't own gold, I urge you to go and buy some. We're the same view. Merrill Lynch have a 2-year spot gold price target of $2,400 an ounce. That's from 1,500. So if they are right, we've got some good times ahead. We introduced a 24-month target of 2,400 an ounce for the end of 2014, so it's not even 12 months now. The new target reflects our view that the Fed will maintain mortgage purchases until the end of 2014 and lower interest rates at the same time. They do not see the gold price to fall below 1,500. We see a gold floor at 1,500 an ounce on emerging market income growth, with emerging markets getting richer. Budget allocations to non-essential items such as jewellery should increase in the long run. So that came out in September 2012 in their Global Metals Weekly. So for the gold investment, which is Series 28, the key features are the same as what I went through for the ASX. The only difference is the underlying investment is linked to the SPDR Gold Trust. So it's an ETF that's over gold. Again, it's a 3-year investment term. Capital protection applies at maturity. You prepay 3 years of interest up front. The interest rate again is 4.95%. Of course, it's in US dollars. We also have a 1% foreign currency hedging fee that is applicable, so 3% for the entire term. So you look at the risk. The risks are the same as what we went through in Series 27. There's no guarantee the gold price will go up. There's no guarantee that it will go up or the investment will go up more than the interest expense, currency hedging fee, and application fee. So if you look at the maximum you can lose, it's the interest, the currency hedging fee, and the application fee. Again, this is all the same as before. Participation rate can be between 0 and 150% of the gold price. At the moment, we're 150%, so if the investment goes up or the gold price goes up 10, we make 15. Conversely, if it goes down 10, we'd lose 15. We've got increased leverage built into the investment. There's no guarantee the investments will go up, and again, the counter and credit risk that I went through a minute ago. So you look at an example, 100 grand, you borrow the $100,000, you've got to prepay 3 years of interest up front at 4.95%, so it's $14,850. Currency hedging fee, 1% per annum, paid all up front, it's 3% for the entire term, which is 3 grand. Application fee of 2.2% also. Total outlay, $20,050. Again, let's look if the market falls by 60% over the 3 years. It's exactly the same as the ASX. It's no different, except the maximum you can lose is $20,050. The increase is, of course, the foreign currency hedging fee. If it goes up, well, if it goes up 30%, again, you make 27 grand, or what works out to be 35% of your investment, being the 20 grand outlay. So not too shabby. If it goes up 30%, obviously it gets to $2,400 an ounce. That's a lot more than 30%, like the Merrill Lynch guys expect. There it is. If you look at the average 3-year rate of return of the simulated performance, if you go back to 2005, it works out to be close enough to 69%. So 69%, which is that figure there, we've slightly underperformed the actual the reference asset being the gold trust. However, 70% over 3 years is still pretty solid. 70%, your 20 grand investment turns into $70,000. Again, past performance doesn't equal future performance, but it often rhymes. So investors' suitability for the income and equity accelerator, because you're borrowing the full investment amount, you've got to be prepared to lose the interest expense, the currency hedging fee for Series 28, and also the application fee. So if you're after a leveraged investment that provides exposure to growth assets, being ASX and gold, this provides you that. Provides a capital protection on the borrowed amount, so you can't suffer any margin calls, and a limited recourse loan, which means it's eligible for self-managed super funds. You can also gain possible diversification in your investment portfolio in your SMSF by considering gold, which somewhat is uncorrelated to other equity assets or property. So to discuss those investments, please organise a meeting with a Sequoia Asset Management Investment Advisor. If you do want one of those, likewise, further information about the SMSF Club, by all means, just put some comments into the questions section, and we'll have a person contact you over the next few days. Other investment that we have is the income enhancer. Now, the income enhancer, again, is linked to the ASX and the gold price. Why it's correlated to the two is because we believe in both of them. The difference between the income enhancer as opposed to the income and equity accelerator is the income enhancer requires you to come out and fund the entire investment amount. There is no borrowing. You put the entire investment amount. It can give you exposure to the ASX200 or gold. You can choose that. The gold is measured by the gold ETF, as we were talking about before, or the spot price of gold. And we will determine which one it will be, depending on which one we can gain the hedging best on. It's going to offer you an attractive income. The gold is up to the gold investment is 9% per annum for the first and second year. That's the annual rate. It's paid twice a year, so it can be met and used to meet your cash flow requirements. We've seen a few clients that are approaching retirement that want more certainty. They like the fact that there's conditional protection. If the market falls 30%, they don't take any exposure to that, or less than 30%. They only take on equity risk if it falls further than that and stays there for the entire 3-year period. So they're happy with the conditional protection, but at the same time, they've seen term deposits where they've had their money, or fixed interest instruments. They've seen their interest rate go from 6% down to 4%, so they've had to cut their standard of living. With gold, it's 9% in the first and second year. With the ASX, it's 7%. Why we gain such a high income is that we're selling every month the upside capital growth potential above 4%. So the maximum amount we can make in capital growth on top of those income returns is 4%. So if it goes up 6 in the month, we only make 4. If it goes up 2%, we make 2. So it's capped at 4 per month. So if you'd like to exposure to the ASX, likewise gold, expect returns to remain relatively flat, at least not go up by more than 4% per month. You can significantly enhance your income and also capital growth returns by investing in our income enhancer. So the fixed income Series 1 is 7%, Series 2 is 9% in the first 2 years of the 3-year investment. In the third year, it's any capital growth that's occurred over the 3-year period. Those incomes are not contingent on performance like the Income and Equity Accelerator. Irrespective of what happens to the underlying, even if it does fall 30%, you're going to get paid them. So the monthly return above the fixed coupon is capped at 4% per month. The conditional capital protection is conditional on a knock-in event not occurring. A knock-in event will occur at maturity only if the underlying investment, whether it's gold or the ASX, whatever you choose, falls by more than 30% and stays there for the entire period. If that does occur, if the market goes down 31%, for instance, you'll get the cash equivalent of that. So if it goes down 31%, you invested 100 grand, you'll gain $69,000 back, plus the 9% income in the first and second year. That is where the knock-in level is for the ASX200 if the investment traded today. So it assumes the initial trade date, the ASX, is today, which is 51,042 when I put it together. It's only an approximate value, but as you can see, when the market did fall below 3,500 points, which is where the knock-in would be set if we traded today, it didn't stay there for very long. It only had a short time where it spiked below those levels. So let's assume the GFC does happen again and we go down to those levels. Our capital is only at risk if the market stays at those low levels for the entire period. So we think the markets are going to go up, but if we are wrong, we think your capital is only going to be at risk for a minute possibility. This is the gold spot price. Obviously, we've had a lot larger rally in gold. We've had it go sideways over the last 12 months. The gold price would need to fall back to $1,100 thereabouts before any capital will be at risk. If Merrill Lynch think there's a $1,500 floor in, it shouldn't get anywhere near that amount. So the knock-in triggers are a long way from where we are today. Similarly, the key risks, while the units pay a fixed income in the form of the semi-annual coupon, there is no guarantee that units will generate returns in excess of that amount. In addition to that, obviously, if there's a knock-in event, your capital is at risk because of that conditional capital protection. Your returns are affected by the performance of the reference asset, being the ASX200 or gold, whatever you choose. Now, that is up to you. Our job is to educate you, to give you information, so you then can go out and make an informed investment decision yourself. I'm a big believer that you don't need a financial planner. What you need is a financial education to be a successful investor and to reach whatever wealth goals that you have. So an example, we invest 100 grand, 100 grand comes out of your back pocket. Again, there's a 2.2% one-off upfront application fee. So the total outlay is $102,200. You've got to fund that full amount. Year one, fixed coupon, $7,000 for the ASX200. Year two, 7 grand. Year three, well, it depends on the performance of the investment over the 3-year period. So it could be high. It also could be lower than the 100 grand if that knock-in event occurs. Series 2, the same investment amount. You've still got the application fee. Cash flow is 9%, so the income potential for gold is higher than the ASX200. Again, the growth and the amount that you're going to get back in the 3rd year or at maturity, you can redeem every quarter, is conditional upon the performance of the reference asset. So if you're after a regular high coupon payment plus capped capital growth potential, like you still believe in equity markets, but don't expect them to go up more than 4% a month, even if they do, 4% a month is still a pretty good return, with conditional capital protection, and you want exposure to the ASX or the gold bullion spot price, you expect their returns to remain relatively flat or increase slightly, or worse, go down a little bit, then it provides you enhanced performance. Again, if you want to talk about that, this is the first time we've come out with Income Enhancer, as we've had more demand for income-producing investments from our client base. So we've decided to be savvy, smart, and put together an investment that offers a high yield. At the same time, to gain that high yield, we've taken on a little bit of calculated risk, but I believe those risks will not eventuate, but they may do if I'm wrong. So those investments close on the 21st of March 2013, which is in a few weeks. So you don't have long to organise a meeting with your investment managers. So I'll go for an hour. I've gone for a little bit longer than that. I apologise if you had something booked for 8 o'clock. But look, I'm happy to answer any of your questions. If you put in the box in the webinar, I think there's a section where you can type some questions. I can attempt to answer them. Now's the time to organise the meeting. Again, if you do want to organise a meeting to discuss the Income Enhancer, Gold, or the ASX, likewise the SMSF Club, which is pretty exciting to be launching that in the coming few weeks. And by all means, put your details in the question area, and we'll make sure Investment Manager contacts you first up. One of the questions is, what do you think will happen to the ASX come election time? I think to lay down the market dislikes uncertainty. And I think when it comes to the election come September, I think the markets are pretty certain that the Labor Party is going to lose. You look at the trend is what's happened in Queensland or just over the weekend in WA. I expect there to be a bit of a landslide victory for the Liberal Party. So if there was uncertainty around who was going to be elected and their policies coming through to implement to affect businesses, then markets will fall back. But I think we're pretty good at the moment. I think you need to actually maximise the screen to get the question box in. A few people would like to organise a meeting with the Melbourne guys. That's fine. About the gold product, if you already have the ASX investment, I think it's important to look at diversification by investing in a number of products. It certainly enhances the chances of you making money. 37 of our investments up. One of our biggest investments that's been our most successful one is Berkshire Hathaway. Berkshire Hathaway or Warren Buffett's investments are up anywhere between 25% and 35%, so it's doing very well. If you want to expand it, I think you have to press the orange arrow according to our IT geniuses. So thank you. Well, I mean, look, I applaud and respect every one of you for joining in tonight. You go back to when we had a webinar 6 months ago, we had about 5 people that registered. Look at the attendees list. We've got about 50 people. We've just gone around the country for investor updates. We've got Perth to go, so if you're in Perth, by all means, organise a meeting or to come along to that conference on Tuesday night, held in the Hyatt in Perth. So we'll be over there. So that'll be good. Looking forward to working with you in the future. If we're already a client, thank you very much for your support. So cheers. I'll see you later. Oh, another question that's come in is what is the minimum investment amount? The minimum investment amount is 10 grand for the income and equity accelerator. That will give you $50,000 exposure. For the income and equity accelerator, I think it's 50 grand as well. Another question: what's the maximum amount? There is no maximum amount. If the gold price doubles, there's a question there from. I can't pronounce your name, sorry for that. If it doubles, you're going to enjoy all the upside. I hope so. That would be very good returns. There's many people that are very bullish on the gold price. So if they are right, we're going to enjoy healthy returns to come, which would be good. Question: my friend missed this session. Will I be able to email it to him? We will have I've recorded it, I believe, so if you do want a copy, want to forward it to anyone or a partner, for instance, by all means, you can do so. If you don't have a self-managed super fund, we'll also give you a free superannuation health check. It's worth around $495, but as soon as you tuned in, we'll do it for nothing. We'll look at where your super's invested. We'll look at what fees you're paying, what asset classes it's exposed to, the performance, whether or not you've got any insurance. So the whole idea to doing a superannuation health check for you and your family is to give you information to decide whether or not a self-managed super fund is suitable. Now with the mini SMSF, I believe more and more Australians are going to take control of their retirement savings. Over 30% of the Australians' retirement savings are already in a self-managed super fund. So if you want to enjoy that trend, by all means do the superannuation health check. Again, just put the details in the questions section and we'll have an investment manager contact you directly and organise a face-to-face meeting wherever you are. Excellent. Well, thank you. Good night.